Welcome to the TAC Index AI Podcast Weekend Edition. This is our deep dive where we blend TAC data, reports, and charts with the latest news and logistics, especially focusing on air cargo. Our mission? Pretty simple, really. We take a stack of compelling sources, pull out the most important bits, and give you a shortcut to being genuinely well-informed. You get the key facts, the insights, and, just enough context to make it all stick. Today, we're diving into the really fascinating world of air cargo logistics, and specifically its surprising connections to the wider macroeconomy. We've got fresh reports here from TAC Index itself, Reuters, the Wall Street Journal. It gives us a real snapshot of what's happening through the lens of air freight.
Yeah, it's actually quite remarkable how these seemingly small data points in air freight, how they can reflect much bigger geopolitical stuff, economic shifts. We'll be looking at, recent market ups and downs, tariff talks, even global conflicts, and how they're playing out in cargo holds.
Exactly. Think of it like a critical barometer for global trade. So let's unpack this. What's been happening in air cargo this past week, this past month? What's it telling us? Let's kick off with the hard numbers. Straight from the TAC Index, they're the leading price reporting agency for air freight. What's the big picture? What are the global rates doing right now?
Okay, so if we look at the global average, that's the Baltic Air Freight Index, the BII80, it edged down again slightly last week. Specifically by minus 0.6% in the week ending June 30th. Now that leaves it down about 5.3% over the last 12 months. But what's really interesting here, I think, is how modest that decline seems. Especially when you think about the huge disruptions we saw recently, flights across the Middle East, all that turmoil.
Right. That's a key point. So despite major geopolitical events, the overall global rate only dipped slightly. But, that global number, it can hide a lot, can't it? Are we seeing big regional differences? Is it the same story everywhere?
That's exactly where it gets interesting. You see this divergence. For instance, looking at Asia outbound, overall rates from China were actually a bit lower going to Europe. Yeah. But interestingly, they were higher going to the U.S. in dollar terms anyway. That suggests, quite different demand pulls on those big lanes.
Okay. And
digging in a bit deeper, Hong Kong, that's the BAI 30 index, it slipped 1.5% week on week. So that's down nearly 11%, 10.9% year on year. And their new BAI spot indices, the ones just looking at the spot market, they lost ground and kind of regained it, shows volatility.
Mm-hmm.
Meanwhile, Shanghai, the BAI 80, that was actually up slightly, plus 0.5% week on week. Still down year on year, though, about 7.6%. And then you look at India and Vietnam. India, rates were higher to Europe, lower to the U.S., Vietnam, the complete opposite. Higher to the U.S., lower to Europe. Wow. Yeah, it really points to very specific demand pockets, doesn't it?
Definitely showing different stories there. Okay, so let's shift focus. What about Europe and North America? What's happening with outbound freight from there?
Okay, so from Europe, rates overall were a little lower. That includes the transatlantic lanes going to the U.S. and also lanes to China. But a bit of a surprise, rates were higher again going to Japan.
Oh, interesting.
Yeah. Frankfurt, the BAI 20, it basically gave back most of the gains from the week before. It dropped 4.5% week on week, still just slightly up year on year, like 1.3%. Sure. But London Heathrow, the BAI 40, whoa, that jumped. A really significant increase of 13.8% week on week.
13.8, that's huge.
It really is. Seems to be driven by gains to Southeast Asia and also North America. And that leaves Heathrow up a massive 31.6% year on year. Now, granted, that's compared to pretty weak levels a year ago, but still.
Yeah.
That London number is definitely a standout figure this week.
Yeah, absolutely stands out. Okay, across the pond then, North America outbound. How did those rates look?
North America outbound was also generally lower week on week, specifically on lanes heading to Europe and to China. However, like we saw with some other regions, there was a specific lane showing strength. Slightly higher rates, again, going to South America. The main index out of Chicago, the BAI 50, that dipped quite a bit, 9.7% week on week, leaves it just barely up year on year, 0.4%. But it was Miami, really, that led those strong rates down to South America. Doing the lion's share of that volume shows that the specific regional trade is, pretty robust.
Okay, so we've got these fluctuating rates, definite regional hotspots, and cool spots. Now, here's where it gets really compelling for me, connecting the dots. How do these big global events, like the recent Middle East conflict you mentioned, or all these ongoing tariff talks, how do they actually hit these numbers? Especially when you throw in something volatile like jet fuel prices.
Right, and this brings us to that cause and effect question. June was undeniably a turbulent month geopolitically. We had that significant escalation in the Middle East, lots of flight delays, cancellations through that airspace, and crucially, crude oil prices shot up. And jet fuel, according to Platts data, jumped nearly 20% month on month by June 20th, before falling back quite sharply after that ceasefire was declared on the 24th.
Wow, nearly 20% on jet fuel. You just automatically think, okay, air freight costs must have skyrocketed, right?
But you said the global index, the BAI0, barely budged. How does that work? That seems, well, counterintuitive.
It really does seem that way at first glance. It's a fascinating kind of paradox. Despite that huge jet fuel surge, despite the Middle East turmoil, the global BAI0 index, it barely moved through June. Drifted down only 1.1% over those 4 weeks.
So why?
Well, when you look closer, it's maybe not entirely surprising. Think about the busiest air cargo lanes globally, trans-Pacific, transatlantic.
Right, they don't fly over the Middle East.
Exactly. They simply don't traverse Middle East airspace. So this really highlights how these complex interactions, supply, demand, specific route characteristics, even how different fuel surcharges are structured, how they can sometimes buffer the global average rate against what look like massive external shocks. It's a really critical nuance.
That is a critical distinction. Yeah, that jet fuel spikes don't just automatically mean rate hikes everywhere. Fascinating.
Yeah.
What about capacity then, especially on, say, the Trans-Pacific, and how does the whole tariff situation play into that?
Capacity has definitely been a key piece of the puzzle, especially how it adapts to policy shifts. We saw quite a significant switch of freighter capacity away from Trans-Pacific routes over recent months. That followed those earlier U.S.-China trade standoffs. Some operators got, a bit bearish on the outlook, but then after that 90-day tariff deal was struck between the U.S. and China, some of that capacity started coming back. Partially restored, I'd say, though maybe not fully back to previous levels. And part of that reason is the impact on e-commerce from the end of that de minimis exemption for small parcels.
Ah, the de minimis. That's the rule about low-value imports coming in duty-free, right?
Yeah.
Big impact on e-com.
Exactly. A huge deal for those direct-to-consumer volumes that often fly air freight. So the market's showing this really complex dance, capacity adjusting pretty quickly to demand shifts, policy shifts. And actually, for more detail there, TaxBase's beta version 2 now gives more insight on multi-leg routes, helps track those capacity moves.
Good to know. Okay, and looking ahead then, you mentioned tariffs. We've got some pretty critical dates coming up, don't we? Things that could shake up supply chains again. What should we be watching?
Absolutely. There are several key dates markets have circled on the calendar. First up, July 9th. That's when a 90-day pause on higher U.S. tariffs on goods from the EU and a bunch of other countries is set to expire. Then, just a few days later, July 14th. That's the deadline for the pause on the EU's retaliatory tariffs against the U.S.
Right. Tit for tat.
Precisely. And then looking a bit further out, August 10th, that's when the 90-day deal delaying those really high, super high U.S.-China tariffs expires. So yeah, lots of potential flashpoints.
And the negotiations around these deadlines, they seem pretty intense, maybe even chaotic sometimes, like the situation with Japan you touched on earlier.
Yeah, Japan's a perfect illustration of the complexity and the unpredictability right now. Weeks of talks apparently haven't produced a deal, especially over that 25% auto tariff President Trump imposed. Japanese officials have been pretty firm, saying they won't sign anything that keeps that tariff. Yeah. And then you see, political rhetoric flying around on social media suggesting the U.S. can just dictate terms.
Right, I saw some of that reporting.
Yeah, regardless of the specifics of who said what, the underlying point is it just creates massive uncertainty for trade flows, for industries relying on stable import-export conditions. It makes planning very difficult.
And it seems like this negotiation style, maybe contradictory signals from officials, direct presidential involvement, it's adding to that chaotic feel across the board.
I think that's fair to say. Look, beyond Japan, you had difficulties with Canada after the U.S. doubled steel tariffs. Talks restarted eventually, but only after Canada dropped a planned digital tax. The U.S. is also pushing Southeast Asian nations quite hard to take a tougher line on China. That includes preventing transshipment goods moving through an intermediary country and even imposing their own tariffs.
Like that Vietnam deal.
Exactly. That newly announced deal, it reportedly specifies 40% tariffs for goods from other countries passing through Vietnam, but only 20% for goods actually from Vietnam.
Puts them in a tough spot.
Absolutely. These nations are deeply tied to both the U.S. and China economically. And even with the EU, talks are ongoing, tariff lines, non-tariff barriers. But the EU is pushing back hard on anything they feel impacts their, quote, sovereign decision-making process. So the common theme, it's very fluid, often feels quite unilateral, and keeps businesses constantly guessing about future trade rules.
It is incredibly clear how tightly linked these trade policies and geopolitical shifts are to the nitty-gritty of air cargo rates. But let's zoom out even further now. How do all these dynamics connect to the broader macro market picture, especially with the latest economic signals coming out of the U.S.?
Yeah, it's a really interesting interplay there. From that global macro view, markets are definitely wrestling with key U.S. economic signals right now. We just got data showing U.S. private payrolls actually decreased unexpectedly in June, and previous job gains revised lower than first thought.
Oh, wow, a decrease.
Yeah, unexpected. And that softening in the labor market, well, it's fueling more bets on interest rate cuts from the Fed, possibly as soon as their July meeting.
Right.
We're actually due the bigger, more comprehensive non-farm payrolls report tomorrow, July 4th. So that'll give even more clarity.
Okay, so jobs market cooling, potentially leading to Fed rate cuts. But what's Wall Street doing? Because it seems like it's marching to its own beat sometimes.
It really does seem that way. Wall Street's shown, frankly, remarkable resilience. The NASDAQ, the S&P 500, they touched record highs just earlier this week. A strong recovery from that slump back in April.
Despite all the trade uncertainty and geopolitical stuff we've been talking about.
Exactly. This resilience seems partly driven by those expectations of easier monetary policy from the Fed, rate cuts meaning cheaper money, and also the continued just massive impact of AI hype on tech company earnings. Companies like Nvidia, Tesla, they've seen big climbs recently.
Yeah.
Really propping up the market.
It's a fascinating contrast, isn't it? Economic data may be suggesting a cool down, but equities are still pushing record highs. What about the U.S. fiscal situation, though? And the dollar?
Well, that definitely raises some longer-term questions about sustainability. President Trump's big tax and spending bill. Projections show it adding something like $3.4 trillion to the national debt over the next decade. And the federal deficit is forecast to hit, well, an alarmingly high 6.2% of GDP in 2025.
6.2%.
Yeah. And that fiscal picture was a key reason. Ratings agency Moody's downgraded the U.S. credit rating recently just by one notch, from the top risk rating down to AA1. We've also seen the dollar continue its slide against other major currencies. It dropped from, around 104 to the euro back in early January to about 118 by the end of June, and against the pound sterling from around 120 to 137.
Okay, so a credit downgrade, a weaker dollar, things you'd normally think would spook markets. Yet, as you said, equities haven't really seemed too bothered. Why do you think we're seeing that disconnect?
Well, there are definitely different viewpoints on this. I mean, yes, long-term U.S. bond yields did move higher after the downgrade, which you'd expect. But people taking the more, optimistic view, they point out that U.S. productivity and growth have actually consistently beaten forecasts since the pandemic.
Right.
So they argue that higher interest rates might also reflect expectations of stronger growth down the line, and maybe just a normalization of rates after that whole era of quantitative easing, the really cheap money policies.
So maybe rates going up isn't just about debt, but also about growth expectations.
That's the argument from one side, yes. It really highlights the considerable debate right now about the true economic outlook and whether the current market strength is, built on solid foundations. And just another small example of policy impact, we saw activity in the U.S. oil and gas sector contract a bit in Q2. Firms specifically mentioned grappling with that jump in steel tariffs. Shows how these trade policies have direct, tangible impacts sector by sector.
This has been a fantastic deep dive. It really shows that intricate dance, doesn't it, between the tiny movements in air freight rates, the high-stakes world of geopolitics and tariffs, and these huge macroeconomic shifts. It's just so clear that even small changes in one area can ripple right across the global logistics and financial landscape.
Absolutely. And I think understanding the granular data, the stuff from sources like the TAC index, it really helps us see the true impact or sometimes the surprising lack of impact from big events, like that jet fuel surge we talked about, or these intense trade disputes. It's really about trying to figure out what genuinely moves the needle versus what might just be, background noise.
So, thinking about all this, what does it mean for you, our listener, as you look ahead? Given the, let's call it unpredictable policy environment coming from the new U.S. administration, tariffs, spending, responses to global events, what kind of fundamental shifts might we see in global supply chains, in investment strategies, things that go beyond just these week-to-week rate fluctuations? What sort of long-term strategies might shippers, freight forwarders, airlines, what might they need to think about to navigate this ongoing, this palpable uncertainty? Something to definitely mull over until our next deep dive. Thanks so much for joining us.